By now, we have all heard about FTX. The company was the second biggest crypto exchange, with many of its users coming from Singapore. It was backed by large reputable companies such as Sequoia Capital, Blackrock, SoftBank, and Singapore's very own Temasek. The new CEO appointed to clean the company up said the case of FTX is worse than Enron, one of Wall Street's biggest accounting fraud scandals. It is that bad. But the red flags were there. I mean, the company's founder, Sam Bankman-Fried, was supposedly playing LOL during a pitch meeting. So why did no one see this coming? According to sources close to the matter, the whole operation was run by a gang of kids in the Bahamas. The FTX inner circle consisted of roommates who stayed together in a lavish penthouse in the Bahamas worth $72 million, purchased with FTX corporate funds. Our main characters include the star, Sam Bankman-Fried, also known as SBF, and the CEO of Alameda Research, Caroline Edison. SBF and Edison lived closely in the Bahamas penthouse and were occasionally romantically involved. Their relationship mirrored that of the two companies, where Alameda Research was siphoning funds from FTX customers to trade. According to leaked balance sheets and blockchain wallet records, they are publicly accessible. SBF has also implemented a backdoor in FTX's bookkeeping system, allowing him to execute commands that could alter the company's financial records without alerting other people. The backdoor was built by another member in the inner circle and one of the residents in the Bahamas penthouse, Gary Wang. At 28 years old, he was the co-founder and the CTO of FTX and the college roommates of SBF at MIT. Living with them was also FTX founder Nishad Singh. Singh has previously worked for Facebook before joining Alameda for 1.5 years, and then FTX as head of engineering in 2019. Other roommates are Constance Wang, then COO and alumni of NUS and TP, who had her first job working on risk controls in Credit Suisse for only 2 years prior to FTX. And Dan Freeberg, still Chief Regulatory Officer of FTX, who was heavily tied into one of the biggest online gambling scandals. He was recorded as one of the attorneys participating in covering up criminal charges and its extent. So why didn't anyone see the red flags? One reason could be that SBF is just really good at PR. SBF was hailed as the White Knight during the crypto market crash earlier this year, when he bailed out multiple high-profile crypto companies. In February this year, he testified before the Senate advocating for regulation in cryptocurrency, an unusual stand for a leader in the crypto space. But in an interview with Vox after the crash, he said that those comments were just PR. In fact, it looked like he put a lot of thought into how he presented himself. SBF was seen often in a t-shirt and shorts with not much done to dress up his appearance, making him look more frugal. He often advocates himself as the ideal billionaire that donates to charity, and is seen in public giving talks about solving the world's problems. In June, he signed a giving pledge, where he's committed to donating most of his wealth away. This image and sense of trustworthiness he cultivated, together with the boom of crypto, could have been what led investors into a sense of security. In a call to investors, Sequoia Capital said that the firm has conducted due diligence, but believed it was misled by the company's founder, Sam Bankman-Fried. It also said in the statement that its investment of $150 million in FTX only accounted for less than 3% of the committed capital of the fund. Similarly, Temasek said in their statement that the investment of $210 million only accounted for 0.09% of the net portfolio. Temasek said that they also conducted multiple rounds of due diligence and had asked about the relationship between FTX and Alameda. They were given appropriate confirmations they were contractually binding. And they also said this: "Perhaps our belief in actions, judgment and leadership of Sam Bankman-Fried, formed from our interactions with him and views expressed in our discussion with others, would appear to have been misplaced." Temasek Trust Director Ho Cheng also said in a Facebook post addressing the matter that some of Temasek's best investments were made by being contrarian, and Temasek can afford to be contrarian because it has its own balance sheet and can think long-term. In Parliament on November 30th, Lawrence Wong addressed Temasek's investments to FTX.
What happened with FTX, therefore, has not only caused financial loss to Temasek, but also reputational damage.
Lawrence Wong also said,
after writing off the FTX investment, Temasek's early-stage portfolio, as at March this year, has generated an internal rate of return in the mid-teens over the last decade, better than industry averages. The FTX loss will also not impact the NIRC, as the NIRC is tied to the overall expected long-term returns of our investment entities and not to individual investments.
He emphasized on the speculative nature of cryptocurrency. The MAS has consistently warned the retail public not to deal with them. So, what happens now? The case is still under active investigation by the Bahamas and the US Attorney's Office in Manhattan. FTX website redirects to the schedule of SBF's court hearing for its bankruptcy. FTX users are still unable to withdraw their money and likely never will. SBF said he felt particularly bad for the people who believed in him and trusted him. New CEO John Ray III is presently working to account for an accurate statement of cash and crypto assets. Ray said the concentration of control in the hands of a very small group of inexperienced, unsophisticated, and potentially compromised individuals was unprecedented. We are still seeing shockwaves from the crypto and the fintech industry. As time passes, this will certainly be noted as one of the biggest startup failures. All because a bunch of kids never pay attention in POA classes. Stonks! Like line go up, boom! Crypto 101, crash money, stonks!